All right, folks, welcome to another episode of Timeless Wealth with Dirk and Dietz. Today, we're going to be talking about our second secret of investing, of successful investing. And basically, that is time in the market and giving your portfolio time, giving the markets time, giving your investment the opportunity and the time to actually grow. Basically, remembering that you're staying on course. Remember why you started investing in the first place, staying on course. In other words, not to be impulsive and just absolutely sell when dire needs come. But I'm going to right away kick it off here with Sean and Amy. They've got a lot to say about basically giving a lot of time in the market. I do have some questions. They have some slides to show us. I do understand our listeners on Spotify and Apple may not be able to see us. So we're going to try to be as descriptive as possible in terms of describing what we're seeing in the slides here and in the graphs. And just wanted to tell everyone, obviously, a happy summer. This is the first podcast episode that we're recording this summer. We're recording over Teams today, so we're hoping it'll be a success. Anyways, let's kick it off. Amy, what do you got to tell us today about some time in the markets?
Well, and I think we'll start, obviously we're in a difficult period of the market, so we'll talk about time in the market, especially during difficult periods to kind of address the current environment. But I think it's important, just as a general reminder, how many times have we all heard invest early, start early, start early? We all heard it from
Sorry, what was the first one? Investor, what, sorry?
Invest early, start
Invest early. Okay, yeah.
Right.
Yeah.
And why did we say that? Right. Because the whole point is having time in the market. If you've got time on your side, you have that many more years for compounding to take hold. And that kind of went to our first secret of successful investing was around compounding. So that's right, the other part of that piece is that time. So starting early and saving often, even if it's a small amount. I know we talk to lots of our clients' children and grandchildren, and we'll tell them, just save whatever you can. Little bit a week, little bit a month, whatever you've got, just start that habit and get that money invested. And you would be shocked at how quickly that can add up for them. It makes an enormous difference. And then it's kind of like, think of it as almost like weight loss. Like once you start to see the success and start to see how your investments can grow, all of a sudden that behavior becomes, well, I can do a little bit more, or what if I change that? And it continues. So it's setting up that good habit longer term is so important.
So as soon as you start seeing results, you're saying that human psychology starts wanting to work harder and harder, or in this case, save more and more and keep it going and going, keep the momentum moving forward. Am I correct?
You got it. And especially during a difficult period like now, that can be hard, right? It can be hard for us to say, invest when you're watching on a daily basis the market go down and you're hearing a lot of negative news.
It seems like a daily basis.
It does.
Yeah.
But it feels like it.
It does. Absolutely.
I mean, one day it goes down 1,000 points, it goes up a few hundred points, and then we do live in extremely volatile time. I think you guys would both agree. It is kind of scary, like,
Actually, you know what, Joel, I've been hearing that for years. Look,
really?
First and foremost, no, it's not more volatile today than it was 10 years ago, 20 years ago, or 30 years ago. Why it seems more volatile today is because the numbers on the indexes are larger, plain and simple. It's an urban myth.
You're saying that the actual value is larger.
Yeah, and this is not me just talking out of my rear end. This is real. I mean, the Wharton School of Business, I remember when I took my Chartered Investment Management Analyst designation, and Dr. Richard Martson was talking about this. They did a whole body of work around volatility in the markets particularly the S&P 500. You don't need Wharton or any other U.S. school of business doesn't care about the TSX, but they focus on the S&P 500, and they categorically came out and said volatility is within 0.01%. This is 2007 data. Was in 0.01% of where it was in 1993, where it was in 1983, and so forth. They had 25 years of historical data. Markets are not more volatile today than where they were in the past.
It definitely feels like it. Like, I don't know, maybe the war right now that's happening, the unfortunate war that's happening in Ukraine, the fact that we're coming out of COVID and what happened during COVID, if it does feel a little bit more scarier than usual. Obviously, you would know more than me. You've been in the industry much longer. But just from the conversations that I hear, even when I turn on the news or go on Bloomberg or Yahoo Finance, whatever, even markets, like the way they frame it, it does sound like it could be a little bit scarier, but maybe these are just words on paper.
Had time in the market.
Sorry, what was that?
Listen, it does feel scary today.
Yeah.
But there's been scary moments throughout the last 50, 60, 70 years. In every decade, there's going to be seminal points where it's frightening to be an investor.
You know, and I remember when I first started in the business, there was this great chart that they had handed out, and it went back, I can't remember how many years, but a long time. And it listed a crisis every single year in the market. There's some sort of crisis. Now, whether the market reacts negatively or positively, that sometimes it works itself out within that 1 year period. But every single year there's something. Like, who would have thought in 2020 we would have been talking about a pandemic? I didn't see that coming. I had no idea that we would be going through that environment. And at that moment, it was horribly scary. Like, we didn't know what that meant. There was not a lot of information available at the time. There was a lot of uncertainty. And when you're in that moment, it's how you react and how you behave is highly, highly important with how your longer term outcome will be.
Yeah.
But what kicked in, and that's during that period, human ingenuity, right?
You got it.
I mean, I always laugh at the U.S. because the U.S. catches a lot of shade in terms of how they behave politically, even though what the reality is the U.S. system is built to be dysfunctional. It was actually designed that way so that you could have a permanent monarchy and instill themselves into the system. But, and I love the saying about the United States is that, the United States will always get it right after they exhausted every other option. That's what they do. And they, basically led the charge in basically discovering vaccines for COVID and basically took the economy up from off the carpet, and we were able to move forward accordingly and have been moving forward accordingly. Again, not without disruption. But at the end of the day, when you aggregate companies all over the world, I mean, if you back it up a step, when you're investing long term, here's effectively the bet, and I'm putting heavy quotations around this. The bet you're making is that globally, there are billions of people that wake up every day.
Yeah.
They go to work or some form of industry, some form of work to make money, and they want to make their lives better. Mm-hmm. And in doing so, they become more innovative, they become more efficient, they save money, they invest things, they do things to the premises that they live in and so forth. And that's a huge long-term surge in terms of productivity. Might not feel like it day to day, but that's what's going on. So when you invest long-term, you're betting that process is still going to continue as time goes on, even though the news feed can sometimes be pretty dire.
Yeah, I mean, that's news for you. Like they always try to show you the worst of things, and no doubt about that. But I do get what you're saying.
The media is incentivized to broadcast anxiety-driven news. They're incentivized to do that.
That part is true. I do get what you're saying, though. Like, when you're making the bets, you're making the bet on the fact that billions of people are going to be productive. They're going to work. They're going to, they're going to earn money. They're going to buy. They're obviously going to buy from corporations, and from corporations that you're probably invested in. And you're betting on the fact that human civilization is still in the, I would say, maybe the paradigm of moving forward and developing and becoming even a better civilization over and over, whether, and I'm talking about across the globe, not just specific civilizations, but just generally human civilizations across the globe. I think it's a safe bet. I think, at least for the extreme foreseeable future, that bet is a safe bet that humans will still want to advance. They'll still want to innovate. They'll still want to create, and they'll still want to obviously enjoy life and spend money. But I wanted you guys to explain, for instance, now you're saying time and the long run. In a huge long run, for example, or in a long runaway, there's always going to be, for instance, downturns, whether they're recessions, whether they're corrections, market corrections, or whatever. And judging just by looking at this graph here that you're showing up on here, Amy, can you guys talk to me about the bull run time frame or the time length versus bear run time length? Because I know a lot of people, from my experience, a lot of people will ask, well, what's the point of investing if it's going to go up and it's going to go down and I'm going to still remain at a neutral point? Is that the case? I know most investors, most seasonal investors, and most professional investors will tell you time in the market is better than timing the market. But how do you know when to go in? How do you know when to go out if the market's constantly going up, down, up, down, up, down? Like, wouldn't your gains be eroded by any losses? right? So let's talk about some length here and some concrete time examples.
Yeah, so the slide that we're showing here, Jalal, shows a period of time, and it shows the average bull market period. On average, they last about 5.9 years. Whereas a bear market, when things are negative, they only last about, on average, a period of a year. So there's much more time that you're in those frothy markets. And if you're looking at this graph, it's almost like you're zooming out, right? Because again, if you zoom in on a down year, like we're going through a period we're going through now, feels awful, feels like it's going to continue for a long, long time. But when you actually zoom out and look at the big long-term perspective, going back to, 1945 till now, you can see there's so much more upside in those markets, a lot more periods where the market is trudging forward. Now, you see it's still a zigzagging line, even though it's generally on the upside. Yeah. But it's again, that trend is an upward trend. And that's the important part. And why about the whole issue, tailing it back to time, is there's no way that we can actively predict when these moments will come or how long they will last, or how deep it will be. And if you miss those days where the market is up, you'll essentially have made no gains at all. And so it's being invested, collecting, and then also it's important to think about a lot of the companies we invest in do pay dividends. Not all of them, but a good majority do. You're collecting a lot of those dividends along the way, even when you go through those dips, which means when the market does finally turn, you have that many more dollars to participate on the upside.
Because of the dividends that you accumulated, right?
You got it. And not to mention if you continue to save during that period of time when the markets are down, or if you add to the portfolio when the market is down, you're buying in at cheaper prices, right? That's, the sell high, buy low sort of thing, right? But it's easy to say it, but to actually do it is difficult. But we'll often tell clients the best time to keep adding and adding is when the markets feel really awful. And you're probably, and a lot of people will talk themselves out of it though, because they'll say, oh, but it could get worse. It could get worse.
If I could jump in, if you look at it in the bull market, sometimes you're in the midst of a bull market and you won't really know you're in the midst of a bull market that's coming to an end until after it's occurred. I mean, that's the natural way markets work. But even when you're in a bull market, it might not feel like it. Like if you look at the squiggly lines in this chart, which shows basically in the bull market, things are going up. And then in the bear market, things are trending down, and it shows the length of each of those occurrences. But even when things are going up, it's not arithmetic upward like that. It goes up and down, like all over the place. And picture my hands going swinging up and down on an upward trend. So in those moments, it can feel like you're not in a bull market when even you are.
Yeah, and just for those listeners, sorry, go ahead, Sean.
You see the markets go up and down every day, right? You feel like they're not gaining any ground. Well, that's because that's the case. If you watch the market each and every day, it does go up and down each and every day. And the probability of it going up or down in any given day, when you look at it from a historical perspective, stripping out history and causation and so forth, just look at the straight, was the market up or down in any given day? The reality is it's a coin flip in terms of the probability of whether it's going to be up or down. It happens historically that the markets typically are up 50.5% of the time, give or take a little bit. And it happens historically that the markets are down 49.5% of the time.
Yeah.
But because of that relationship, basically from a month perspective, months are up typically 55% of the time, give or take, and they're down 45% of the time. Because of that relationship, any given year, you're going to be up 60% of the time and down 40% of the time because of the aggregation of being up more 55% of the time or whatever compounds on a forward basis. Because of that relationship, over a 3-year period, you're going to be up 80% of the time. Over a 5-year period, you're going to be up 90+% of the time. And over any rolling 10-year period, over the past 100+ years, you're up 100% of the time.
That's pretty awesome.
Sean, to your point, the slide we're showing now talks about annual returns and then the intra-year. So this is interesting to look at because if you take a period of time, to Sean's point, if you're watching your portfolio every day, sometimes you feel that need to react or to do something. And sometimes the best thing is to do
I
absolutely
always ask
nothing.
if someone's watching their portfolio every day, why do they dislike themselves so much? Because you're
Yeah,
basically
for sure.
subjecting yourself to psychological torture.
It is.
Needlessly. You don't if you own good companies, you don't have to worry about it day to day.
Yeah. And we don't have to journey back too far. Like think of 2020, right? So at one particular, it was March 2020 where the wheels fell off the market. And you can see in this chart, the markets were down, 27%. Now, if you reacted in that moment and you sold or you got out and you were, not feeling so great and you reacted, well, you would have missed how the year turned up. The market ended up 16%.
Oh, is that what this shows? So it was down -27, and then it ended at positive 16%.
Yeah.
Okay, gotcha.
Another way to look at another.
Yeah. Sorry, to give you an example, if you look at, I'm going to suggest, let's say 1995. I'm just picking that out randomly, right?
Yeah.
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 The global markets were up somewhere in the neighborhood of 34% in 1995, but at one point they dropped 3%. In other words, the overall return that year, at some point in that year, was -3%. And yet you ended up on a plus 34% trajectory.
Mm-hmm.
Okay. And
2008 is another good example, Joel. Like 2008 was an ugly, ugly year. And one of the things we're most proud of is we didn't have a single client sell in that environment. Now, it felt awful and a lot of people wanted to sell and we were along with them. It didn't feel very fun. But you can see if you would have panicked at the worst point in time, the markets were down, 32%.
32%, yeah.
But within that year, it was still down. You were still down 23%. But then look at the following year and how the markets came back. Now, if you would have just stuck with it, you would have made your money back that much quicker versus the person that sold at a -32%. They've got a much harder fight to get back to where they were.
Yeah, and correct me here if I'm wrong, guys, but just for our listeners that cannot see the graph, and by the way, for everyone that's listening, our podcast is also on YouTube, so these graphs, the whole video will be showing up on YouTube. But I just want to explain and describe a little bit about what we're seeing. So, Amy, you're saying that in 2008, if I understand this graph correctly, the dark black where it says -32%, that's the maximum decline. That was the least amount that the market was down during that year, correct? So it didn't go down below 32%.
Right.
Am I understanding that correctly?
Right,
and then it ended up so it ended that year, 2008, it ended it at only -23%.
Right.
So if you had sold at, when it was really down at like 32%, if you had waited, if you had sold at the end of the year, you would have only lost 23% versus the 32% if you had sold at the maximum lowest point. However, if you had waited till the next year, I think that's 2009 right there, you would not only make all your money back, but 2009 also ended up, the year ended with a 10% increase in the market, correct?
Mm-hmm. That's right.
Okay, so for our listeners that cannot see the graph, we're seeing two different numbers here. One of the numbers, which is usually the lower number, that's the maximum decline of the market during the year, and then the other number represents how the year ended, how the year concluded itself in the market. Gotcha. Yeah. So yeah, if you look in 2020, in March when COVID-19 hit, it was down -27%. But if you had waited till the end of the year, you actually would have been up 16% than what you even started on top of what you started that year. Okay.
Right.
Perfect. Yeah.
And again, the person that sold at the bottom, is foregoing any of the dividend income, all of that to sit in cash and then try to guess when to jump back in. Right. And so
Understood,
that's even more difficult hurdle for them to overcome.
Yeah.
Which speaks to, the psychology of investing successfully, because at the end of the day, you can't time these things and talk about what the market's going to do in the future, because again, typically it's going to be a coin flip in terms of whether the market's going to be up or down at any given day. There's some causal predictability that may suggest markets are going to be down more so than up, but generally speaking, that's the relationship. And so the best thing you can do, assuming three things: one, you're properly diversified.
Yeah.
Two, you're not speculating.
Oh, here it is. Here's Sean's favorite thing to do. What to do when things look like they're about to hit the fan.
Well, the second best thing you can do, and sometimes
Yeah.
it's the hardest thing to do, is absolutely nothing. If you
Yeah.
invest in quality companies, you're properly diversified by geography and asset class, and you're not speculating, you'll be fine. And that's something we've spoken to in the past.
Yeah.
Earnings of quality companies are much more stable than the actual share prices of those companies. And they're stable, and they can tend to be upwardly trajecting. The best thing you can do is, if you're in a position to invest, you invest during times when you least want to.
Pick up some more when it feels really hard to do so.
And there's a couple little known investors that are very good at doing that. Like Warren Buffett and Charlie Munger. That's how they behave. And they tell everybody, they'll scream from the mountaintops saying they're behaving that way. I'll never forget Warren Buffett in 2008, when everyone was running around with their hair on fire, came out with his famous Buy America. He was Buy America. So he goes, this is the buying opportunity of a lifetime. No one would listen to him. So he went out and bought America, made billions. And some of the deals he got were just off the charts. I mean, he structured, he was called to bail out Goldman Sachs. People may recall this years ago. He was called to bail out Goldman Sachs because TARP was not enough to save them. And so he said, sure, I'll bail you out. He basically provided them, as I recall, $1 billion note. It might have been 10 billion, but somewhere, I think it was $1 billion note that paid him 10% annually with options to buy the shares at somewhere in the neighborhood of $30 US a share.
Jeez.
And where is it trading now? $250 a share. I think he made like $8 or $9 billion on that transaction alone over the next 5 years.
Wow. It's the power of compounding.
Yeah.
He saw what other people see.
He bet on the United States to get the hell out of the recession and get itself back on track. Yeah. That's what he meant by Buy America, right?
He came out and said buy, but Ray Dalio did that. I mean, George Soros was very active during that period of time. Billionaire investors they're just they think very differently than the average retail investor. And frankly, I hate to say it, they take advantage of our emotions.
Well, and here's the thing, that headline that Warren Buffett came out and said, Buy America, that headline didn't sell as much. We're showing on the slide now some headlines from Time magazine in the past, going back to the 70s, and then I'll flip it to journey it all the way to current date. But look at the headlines. These are the headlines that sell. Negative news. Like if we journey back to July 17, 1978, the inflation fighter, or July 2nd, 1979, the energy mess. Here's another good one. March 2nd, 1981, the axe falls. Reagan's plan for a new beginning. Interest rate anguish, the deficit monster. Like these are, headlines that people are going to go, whoa, what's happening? This is compelling, that things are going to get worse. But the interesting thing is if you actually look at the date that these headlines came out, and if you were to invest at the time that horrible headline came out and journey out 10 years, you can see the rates of return. And for those of you that can't, I'll read off some of them, but they're substantially higher. So we'll pick one here. I'll pick one more current date here. Here's one, December 3rd, 1984, awash in troubles, America's banks. Now, if you were to invest on that date and journey 10 years ahead, later, your cumulative return was 288%.
What was happening? What happened in 84? Anyone know? Like December 3rd, 1984, that awash in trouble. So basically, you're saying that if they had invested on December 3rd, 1984, when this issue of the Time magazine came out, and they had waited 10 years, so it would have been what, 1994, just like around December 1994, their return on their investments would have been 288%.
Yep.
If you go back, I mean, this is all time during the Cold War. This is also really interesting. Like when people thought, Russians were going to be shooting us from outer space with lasers or like guns from outer space. So it definitely a scary time during, especially the late stages of the Cold War. But shows some really big. Like, look at this one. If you had invested on October 15th, 1990, and waited 10 years on your investments, right, where it says time, high anxiety, I think that was just before the fall of the USSR. So up until, if you had given your investment's time up until October 15th, 2000, your return would have been 468.69%. Wow. So time is a virtue in the market, but you still need good quality stocks. It's not like you just pick up, right, Sean? Like, it's not like you just pick up whatever and give it time. I think I've had this discussion with you that, okay, if I had unlimited time, wouldn't any investment at least make it out? And you said no. You still have to do your due diligence, either hire a professional or at least do your due diligence in terms of knowing where to invest and where to put your money.
You want to know. You want to know what you own and why you own it.
Yeah.
Because when times inevitably do get tough, and it's going to happen, you want to be able to look at your portfolio and say, look, I own TD Bank, and I saw the branches are still open and people going in and out and doing stuff, and that's good. I saw the trains are still running. I own Canadian National Railway, so on and so forth. I booted up my computer and up popped Microsoft, like so on and so forth. That's kind of the rationale behind it. So you don't get panicked out of the market because you change your rationale from I own equities or stocks or whatever you call it into I own shares of ownership in a business, a viable, profitable business.
Yeah, knowing
a big majority of investing is psychology, and it's very easy to say it, and everyone can say, "Oh, I can do it. But when times get tough, it's human nature, right? When things don't feel good, if you put your hand on a stove and it's hot, you don't say, "Well, I'm just going to keep it there and hold it on there." It's like, no, it hurts. I remove it. I'm investing. It hurts. We're saying you have to overcome that feeling, and we're saying, at least keep your hand on it or lean into it even more so. It's just very, very difficult to do. So Sean's point, if you open up your statements and at least you can recognize what you own and understand why you own it. And again, you can use your eyeball test and see that these companies, you're using their products. That's going to let you sleep a lot better at night than in owning like a black box investment that you're not really sure what exactly it is.
Yeah.
And I think in closing, this next chart's going to really illustrate why it's important that you don't get head faked out of the market.
Yeah, this one, if time hasn't sunk in, I think this chart will hit you right over the head. So this is looking at the S&P 500 price return from 1930 to 2020. Now it's saying if you were to invest during that period of time, and if you exclude the 10 best days per decade, so that's 90 days over a 90-year period. If you miss those days, your rate of return would have been 28%, 28%.
Versus what?
Versus 17,715%.
So are you telling me?
Yep.
Are you telling me?
I'm telling you.
That over the span of 32,850 days, if you miss 90 of them, or a quarter of a percent of those days, you just missed that much, you might as well have done nothing.
Exactly.
In 90 years, you would have only gone up 28%.
Yeah.
I'm not buying
versus.
You're going to have to be a pretty darn, tell the future pretty darn well to time that. I don't know how anybody could time that, but
I was just going to say, is there any way to figure out what those 90 days are? Like, not even the best technical analysts will be able to tell you the pattern recognition?
No.
How many billionaire technical analysts do you know, Jalal?
None.
Yeah.
None.
Just asking.
Yeah.
None.
And then the other question, here's the other thing too. How many billionaire despondents do you know? Like how many billionaire pessimists do you know? Most billionaires tend to be optimists. They tend to be forward-looking, and they tend to look at times of disruption as opportunity because they implicitly understand that chart there, that picture there, better than anybody.
I know none billionaire pessimists. You can probably claim, I don't know, maybe Musk is a little bit of a pessimist in some areas, but
how is he a pessimist? He's sending rockets into space and internet service all over the world. He's doing all sorts of crazy stuff. He's bearing children all over the place. I mean, he's an optimist of the highest degree, I think.
I agree. Like in terms of innovation, he's definitely an optimist, and in terms of humanity, moving forward, especially going more towards like
And
net
be
zero
pessimistic. I
emissions.
would bring 9 children into this world.
I didn't know he has 9. He has 9 kids.
Yeah.
Yep.
Oh, I didn't know
There's
that.
one out of 9 kids, and he's got.
I did not know.
Headlines news yesterday.
I do know. So I was actually reading, and Sean or Amy, maybe you guys can touch upon this. I ran across this this article not too long ago. I know things look really bad right now,
Yeah.
but I did read that insider buying is actually really, really high.
Why
So
do you think
insiders
that
are
is?
actually buying their own stocks. I don't know. I think maybe they know that things are looking up in the near future. I don't know. What do you think? RBC though did just release a report today saying that if Canada is going to hit a recession, it's going to be in 2023. It's going to be moderate and very short-lived. Like it's going to be a very short recession. RBC just released it today. But insiders are buying. Like I think it's at a decades high where insiders are just buying their own stocks.
So you're an insider of a company, right? You know your company better than anybody, theoretically. Not all the time, theoretically.
Okay.
And you know that you know how well your company is doing.
Yeah.
And you look at where your share price is, and you go, why wouldn't I buy that? So, it's somewhat parallel to insider buying being at near all-time highs. I don't know if it's quite all-time, but it's close, right?
It's pretty darn close. Yeah, there was a graph that was shown. Yeah.
If you look at share repurchase activity, like companies buying back their own shares,
yeah,
that's going through the roof right now too.
And dividends, I think you've said previously, dividends are also increasing too, right?
We'll put dividends on the shelf. That's a separate conversation. But repurchase activity, where a company goes out and buys back their own shares, reducing the overall share flow, which means anyone who's left over still holding shares gets a larger piece of the earnings pie, so to speak. Well, they're out there repurchasing like crazy because they know their shares are undervalued. And if you're buying back shares, what better time to buy them back than now versus a year ago?
Right. Yeah. I mean, things are
more for the same dollar you're spending.
So that's some light for the tunnel. Some light for the
dividend increases are also above historical norms.
Yeah.
That's still happening. And a company that increases its dividends, they're trying to do a hardcore signal to their shareholders and to the investing public at large that they think long-term things are going to be fine.
Yeah.
Because companies that increase their dividends, they're really behooved to reduce them at some point in the future. They never want to do that.
No.
So
if they're increasing it, that's going to be the new threshold. They'll never decrease it more than that.
Well, you can't say never, but it would be a very bad sign to the market if you did that. So they're very
confident
careful.
Yep.
They're very careful when they increase it because they want to be sure that they can withstand that. And a good example of that was Canadian banks going through 2008, where you had a U.S. bank, Lehman Brothers, go bankrupt. Not a single Canadian bank cut their dividend. They didn't increase it, but they held it because that would be a very, scary signal to send to the market. People would panic and things like that. So they're very careful before they increase it.
But then they started increasing dividends in, I believe, 2010 and increased them as an aggregate for the next, 12 years. They had to stop around COVID because OFC told them to stop.
Yeah.
And now what you have, and this is again an interesting environment we find ourselves in. Canadian banks are down anywhere from 15 to 20% from their recent highs. They on average have increased their dividends in the past year somewhere in the neighborhood of 15%. And collectively, they're sitting on too much tier one capital. They have too much unencumbered cash on their books, which draws down their earnings. They got to get rid of some of it. They have too much of it. And so what's the best way to get rid of it? Repurchase your shares or dividend it out to the shareholders.
And of course, when they increase their dividend, they have the confidence to know, generally speaking, that that's the new threshold for their dividends. Like, unless, I don't know, some kind of apocalypse happens, maybe they don't want to decrease their dividends. Like, it's not just like an up and down cycle. They'd rather increase it and keep it at that level for the foreseeable normal future.
Now, I'll give you an example of this in action. So FedEx recently came out with their earnings a few weeks ago, and they increased their dividend by 50%. Well, FedEx just didn't arbitrarily do that. They didn't say, well, I'm just going to pick a number and increase it to that level. They spend somewhere in the neighborhood of $500 million a year or more forecasting economic activity around the globe because they're at the thin edge of the wedge of that activity in terms of logistics, right?
100%.
So they have to be pretty damn sure that things are going to progress according to plan for them to say, okay, we're going to take our dividend and raise it by 50%.
And you're saying
That's-
50,
some of
50,
that, their business model is going to be fine.
right? Sean, you're saying 50, right? 50%?
50, yes.
Oh, wow. That's a huge increase.
Yeah. But they wouldn't do that just for the sake of it. They're pretty darn sure, like I said, that their business functioning is going to be pretty stable and growing over the next while.
So again, going back to time, it's you have those types of companies in your portfolio. That money continues to come in either on a monthly or quarterly basis or annual basis, whatever the company has paid it. But you have that money coming in, and again, that many more dollars to participate when the markets recover. So it's sticking with it, as horrible as it feels at times, and just keep doing it, right? And again, start early. Time is a huge component to a secret of success.
Yeah,
Give your
comment
investments time.
on this is if you look at it from the dividend perspective, although repurchasing shares has a similar effect, it says it doesn't create cash in your hand. If you look at a down market like this, the share prices get, depressed in value, and yet the dividend activity is continuing. They're still increasing dividends and so forth. So like, for instance, the average dividend growing company on the S&P 500 tends to grow their dividend 12% per year. That's on average. If inflation's running at 8, well, your income stream is still preserving its purchasing power relative to inflation, even at 8%, because your dividend growth rate is higher than that. And you're able to buy at lower prices, which means your yield on that security is that much higher.
Right.
So that's the advantage of buying low. I mean, it sounds obvious. I mean, I always joke when people say, hey, what advice can you give me? I always say buy low, sell high. I mean, but it's kind of true. Like buy low because you're getting better value for your dollars.
Yeah.
But the underpinning of why you want to own that investment doesn't change.
Yeah. So just to conclude it, guys, I think, as Amy said, start early, invest early, and really stick by your guns. Like, remember why you invested, even if there's some downturns, even if there are some corrections in the market, which we, as economically speaking, or in, I guess, economic theory speaking, it is kind of healthy. It's kind of natural for a market to go through corrections and perhaps even in recessions. But the point is, you don't want to forget why you originally started investing in the in the get-go. Just remember that it is a long-term game. You're not going to get rich in probably a year or two. Like, Hollywood does a really bad job in portraying that and conveying that people are going to become millionaires in a year or two just from, well, technical analysts are the ones that show this. I feel like they're the ones that are behind this concept, this theory that, like, you can time it and become rich in a very short amount of time. But I think that's highly unlikely. But the point is, give your portfolio time, give your investments time to grow, right? Like, don't cut it at the knees as soon as it starts getting some treads, and just when things have a little bit of havoc, I'd say.
And just to close out your thought on that, Jalal, about trying to time the market and technical analysts and so on and so forth. If you look at, and you can Google this, I don't have it in front of me, but if you look at the aggregate returns of a hedge fund index in the United States, hedge fund, against the S&P 500, the hedge fund managers have woefully, in aggregate, underperformed the broader base market over time, like woefully, versus the long managers, at least, from an aggregate performance standpoint, have a chance to be in the ball game. And then basically, because they're advised and their clients don't sell at the wrong time or buy at the wrong time and so forth, they tend to do better than unadvised, let's say, investors that try to do things.
Gotcha. All right. Well, thanks a lot, everyone, for tuning in for today's episode on the second secret of investing. Just remember, the first one was compounding, and the second one is time. Give your portfolio, give yourself, and give your money some time to actually work for you and grow. And we'll see you guys next time.
Bye.